Brent crude oil just posted its biggest monthly price decline since March 2020, the month the world went into COVID lockdown. Oil is now trading around $73 per barrel after touching nearly $112 per barrel earlier this year when the US-Iran conflict disrupted the Strait of Hormuz. That is a $39 drop in a matter of months. For anyone living in the Middle East or with financial exposure to the region, this is the most important economic story of the moment. What caused the price collapse? Two things happening simultaneously. First, the interim peace deal between the US and Iran eased the Strait of Hormuz disruption that had pushed prices to their peak. With the strait operating more normally, the fear premium in oil prices disappeared almost overnight. Second, underlying supply and demand fundamentals reasserted themselves. Global economic slowdown concerns, including that weak U.S. jobs report, are reducing demand expectations. The direct impact on the UAE economy. The UAE has diversified significantly. The non-oil sector is now driving the majority of economic growth. Tourism, finance, real estate, and technology are all expanding independently of oil revenue. However, the GCC region as a whole remains sensitive to oil price cycles, and government revenues across Saudi Arabia, Kuwait, and Bahrain are significantly more oil-dependent than the UAE. What this means for UAE expats specifically: job security in sectors with significant government contract exposure deserves a second look. Construction, infrastructure, and energy-adjacent industries feel oil price movements through government spending decisions that typically lag the price move by 12 to 18 months. The impact on your employment is not immediate, but it is worth being aware of the trend. The investment angle. Energy stocks globally fell sharply with oil prices. If you hold a globally diversified index fund, you experience this through the energy sector weighting. Oil price crashes also historically improve consumer spending power as fuel and energy costs fall, which is net positive for consumer companies and the broader economy outside the energy sector. The broader geopolitical context. U.S.-Iran peace talks continue under a fragile interim deal. If talks break down, oil prices could spike again rapidly. If a full deal is reached, oil could fall further. This specific geopolitical risk is live and unresolved. Building your personal finances to be resilient to energy price volatility rather than dependent on a specific price level is always the right long-term approach.